There is a rule. A single rule. That has predicted every major financial collapse in modern history. A rule so precise, so ruthless, so mathematically brutal that the men who discovered it refused to talk about it in public for decades. Because when you know this rule, really know it, you can never look at money the same way again. And the terrifying part? Most people are breaking it right now. Today. With their savings. With their retirement. With everything they've worked their entire lives to build. One man figured it out. Not in a classroom. Not in some quiet corner office on Wall Street. He figured it out the hard way, through humiliation, through ruin, through a failure so catastrophic that it brought him to his knees on the floor of his own apartment, staring at the ceiling, wondering if his entire life had been a lie. He lost everything. And then, somehow, he came back. And what he brought back with him changed the financial world forever. His name is Ray Dalio. And what he discovered in the wreckage of his own destruction is the one market crash rule that nobody follows. Not because people don't know it, but because human psychology makes it almost impossible to obey. Until it's too late. Before we go any further, I want to ask you something real. Think about where your money is right now. Think about your investments, your savings, your 401k, whatever you've got. Now ask yourself honestly, if the market dropped 40% tomorrow morning, would you survive? Drop your answer in the comments. Yes or no. I genuinely want to know. And if this video makes you feel something, if it shakes something loose in your chest, smash that like button and subscribe. Because what comes next will change how you see everything. Raymond Thomas Dalio was born in 1949 in Jackson Heights, Queens, New York. His father was a jazz musician. His mother stayed home. The apartment was small. The money was tight. There was nothing particularly extraordinary about the boy. No trust fund waiting. No powerful connections. No blueprint for greatness handed down at the dinner table. What Ray Dalio had was a paper route. And a curiosity that burned like something alive inside him. He was 12 years old when he first touched the stock market. A caddy at a local golf club, he overheard men in expensive shoes talking about a company called Northeast Airlines. The stock was trading at around $5 a share. Ray bought 3 shares with the money he'd saved from carrying their bags. The stock tripled. Not because Ray was a genius, he'll tell you that himself. But because Northeast Airlines merged and every investor got shares of the acquiring company. He got lucky. And luck, for a 12-year-old kid from Queens, felt indistinguishable from destiny. He was hooked. Absolutely, completely, irreversibly hooked. He started devouring financial reports. He read everything he could get his hands on. He had a gift, not for memorizing numbers, but for seeing patterns. For sensing the invisible architecture beneath the chaos of markets. By the time he got to Long Island University and then Harvard Business School, he wasn't studying to learn. He was studying to confirm what he already suspected, that markets weren't random. That there were rules buried beneath the noise. And that whoever found those rules first would own the world. He went to work on Wall Street. Merrill Lynch. Then he started trading commodities. And for a while, for a bright, burning, intoxicating while, everything he touched turned to gold. But here's where the story cracks open. It's 1982. Ray Dalio is 33 years old. He has already founded Bridgewater Associates out of his 2-bedroom Manhattan apartment. He is a man who moves through the world with total conviction. He has appeared before Congress to testify about the economy. He has predicted on national television that the United States is heading toward a catastrophic depression. The banks are over-leveraged. The debt is unsustainable. Mexico is going to default. And when Mexico defaults, the dominoes will fall. Ray Dalio is absolutely, 100%, staking his entire reputation on this call. And then Mexico defaults. And instead of a depression, the Federal Reserve cuts rates. The market rallies. The economy roars back to life. Ray Dalio was wrong. Not a little wrong. Catastrophically, humiliatingly, existentially wrong. He had to let go of every employee at Bridgewater. He was so broke he had to borrow $4,000 from his father just to pay his family's bills. $4,000. From his father. A jazz musician. The Harvard MBA who testified before Congress was borrowing money to keep the lights on. He sat on the floor of his apartment. Just sat there. The silence of that room, you can almost feel it through time. The particular, suffocating silence of a man who believed in himself completely and watched that belief shatter into pieces he didn't know how to put back together. He was staring at the ceiling, wondering if he was simply not as smart as he thought he was. Wondering if the whole edifice of his confidence had been nothing but arrogance dressed up in analysis. That moment, that floor, that ceiling, that silence, that was the beginning of everything. Because in the wreckage of that failure, Ray Dalio did something that almost no one does. He didn't just pick himself up and try again the same way. He stopped. He thought. He asked a question that most people are too proud or too scared to ask. What if I'm wrong about the way I think about being wrong? He started writing. Not trading. Writing. He began documenting every single decision he made. Every trade. Every prediction. Every assumption underneath the prediction. And then, ruthlessly, obsessively, he compared what he thought would happen against what actually happened. He called it a pain journal. Every time reality disagreed with his model of reality, he forced himself to sit with the pain of it and extract a principle. Not a vague lesson. An actual, operational principle. A rule he could follow next time. And slowly, painfully slowly, the rules began to take shape. He realized something that sounds simple but will rearrange your brain if you really let it in. The biggest threat to a good decision maker is not stupidity. It's confidence. Specifically, it's the blind spot that confidence creates, the invisible wall that keeps you from seeing the information that contradicts what you already believe. He called this the most insidious threat to good thinking. And he built his entire empire on fighting it. Bridgewater came back. Quietly at first. Then with a kind of momentum that felt almost geological, slow and then suddenly, overwhelmingly fast. By the time the 1990s arrived, Bridgewater was managing billions. By the 2000s, it was the largest hedge fund on earth. And through it all, Ray Dalio kept refining the rule. The rule. The one that had been hiding in the ruins of his 1982 collapse. Here it comes. Pay attention. The rule isn't a stock tip. It isn't a technical indicator. It isn't some algorithm that identifies overbought markets or Fibonacci retracements. The rule is this: most people lose everything in a crash not because they don't see the crash coming, but because they are positioned to need to be right. They are all in on one bet. One idea. One sector. One narrative about how the world works. And when reality disagrees, when the tide goes out, there's no margin. No fallback. No survival. Dalio calls it the holy grail of investing. And it's heartbreakingly simple. You need 15 to 20 uncorrelated return streams. Assets that don't move together. When one falls, another rises or holds. Not because you predicted which one would fall, but because you built a system that doesn't require you to be right. You built a system that survives being wrong. Think about what that means for a moment. Really sit with it. The entire financial industry is built on conviction. On selling you the certainty that someone, some fund manager, some analyst, some television personality in a sharp suit, knows what's going to happen next. And so everyone piles in. Everyone takes concentrated positions. Everyone needs to be right. And then the crash comes, as crashes always come, and the people who needed to be right are destroyed. Because the market doesn't care about your narrative. It doesn't care about your analysis. It doesn't care about your confidence. It has its own logic. Its own tides. Its own brutal indifference. Dalio saw this coming in 2007. He watched the debt cycle building. He watched the leverage accumulating. He watched the housing market metastasize into something unrecognizable. His team built a model they called the D process, a template for deflationary depressions drawn from studying every major economic collapse going back 100 years. And when 2008 arrived and Lehman Brothers folded and the world's financial system came within hours of total disintegration, Bridgewater didn't just survive. They made money. 18% returns in a year when the S&P 500 lost 37%. Not because Dalio is a wizard. Not because he has some supernatural gift for prediction. Because he built a machine that didn't need to be right. A machine designed to survive the thing that everyone else refused to believe was coming. The tragedy, and this is the part that keeps financial historians up at night, is that the rule was always available. Dalio has written about it. He has spoken about it. He published Principles, a book that sold millions of copies and laid out his entire philosophy in granular, obsessive detail. He stood in front of cameras and audiences and explained, slowly and clearly, that the number one mistake investors make is failing to diversify across truly uncorrelated assets. Not just stocks and bonds. Not just domestic and international. Genuinely, mathematically uncorrelated streams of return. And almost nobody listened. Not really. Because listening would require admitting that you don't know what's coming. That your favorite stock might be wrong. That your gut feeling about the economy might be a bias dressed up as insight. And that is a form of intellectual humility that feels, in the moment, almost identical to weakness. We are built for conviction. We are wired to believe that the confident voice is the one worth following. And so we follow the confident voice right off the edge. Dalio watched it happen again in 2020. The pandemic crash, sudden, savage, terrifying. Markets down 34% in 33 days. The fastest crash in American financial history. And again, the people who were concentrated, who were leveraged, who needed to be right, they were obliterated. While the people who had built what Dalio calls the all-weather portfolio, positioned for any economic environment, not betting on which one was coming, absorbed the shock and recovered. The rule works. It has always worked. And people keep not following it. Why? Because following the rule means accepting uncertainty as a permanent condition. It means building for a future you cannot predict rather than betting on the one you're convinced is inevitable. It means looking at your portfolio and saying, I am wrong about something in here. I don't know what. But I am wrong about something, and I have structured my finances to survive that wrongness. That is not the language of a confident investor. That is the language of a philosopher. And most people don't come to the financial markets looking for philosophy. They come looking for certainty. For the hot tip. For the 5 stocks that will change everything. Dalio himself said it best in a moment that stopped a room full of the most powerful investors on earth. He said, "The biggest mistake investors make is to believe that what happened in the recent past is likely to persist." Read that again. The biggest mistake is believing that the recent past is a reliable guide to the near future. Bull markets feel permanent until they end. Crashes feel catastrophic until they don't. And the investor who built their entire strategy on the assumption that the recent environment would continue, that investor is always the most exposed when the turn comes. Ray Dalio is 74 years old now. He has stepped back from the day-to-day management of Bridgewater. He has given away billions to causes ranging from ocean exploration to education reform. He has written books and given interviews and appeared on stages around the world, trying, with what seems like genuine urgency, to share what he learned on that apartment floor in 1982. The rule. The one rule. Diversify across uncorrelated return streams. Build for uncertainty. Stop needing to be right. And yet, the concentration continues. The leverage continues. The conviction continues. Every generation of investors relearns the same lesson in the same catastrophic way, because the lesson requires you to act against your instincts before the disaster arrives, not after. After is too late. After is the floor of the apartment. After is borrowing $4,000 from your father. There is something almost unbearably human about this pattern. We are creatures of story. We believe in narratives. We invest in ideas. And when the idea is compelling enough, when the narrative is vivid enough, we stop asking what happens if we're wrong. We stop building the escape hatch. We stop leaving room for the world to surprise us. Ray Dalio built his entire life's work in that escape hatch. In the space between conviction and catastrophe. In the discipline of preparing for the crash that everyone else insists will never come. The crash is always coming. Not necessarily tomorrow. Not necessarily this year. But the cycle turns. It always turns. And when it does, there are 2 kinds of people in the market. The ones who needed to be right, and weren't. And the ones who built something that could survive being wrong. Ray Dalio chose to be the second kind. In the ruins of his greatest failure, he found the only principle that actually matters. Not genius. Not prediction. Not certainty. Resilience. Structural, mathematical, deliberate resilience. The market crash rule nobody follows isn't complicated. It's just hard. Hard in the way that all true discipline is hard, not because it requires extraordinary intelligence, but because it requires you to act against the part of yourself that whispers, "This time it's different. This time I know. This time I'm right. You probably aren't. And neither am I." And neither, in 1982, was the man who built the greatest hedge fund in human history. The question is, will you build something that survives being wrong? Or will you wait until the floor to find out you should have? That's the rule. That's always been the rule. And the clock, as always, is already running.